I'd like to welcome everyone to Pembroke Speaker Series, where we help provide some commentary on the markets and portfolios in the current environment and provide an outlook on how we help manage clients' capital. So today we're fortunate enough to have Canso Investment Counsel with us. And for those of you unfamiliar with Canso, they're an investment management firm based out of Richmond Hill, Ontario, that currently has an AUM of approximately $38 billion, well trusted by institutions and private clients across the country. Pembroke has been partnered with Canso since 2009, and Canso has managed the corporate bond portfolio to a 5-star rating currently, so we thank them for that. I would like to also welcome my esteemed colleague Peter Morton, the Vice Chairman of Pembroke, who will be helping me co-host, and especially welcome Portfolio Manager Tim Hicks and Portfolio Analyst Faisal Ahamed from Canso Investment Counsel. So with that, I will pass it over to Tim and Faisal, and they can do a little bit of an intro on Canso, and then we'll begin sort of a question and answer period.
Okay, thank you very much. And I'm Tim Hicks, and thank you for tuning in today. We're Canso. We're very proud to have a long association with Pembroke, and happy to take a few minutes today to talk to you about the somewhat more boring investment of debt versus equities, but it can be interesting at times, and we'll hopefully make it as interesting as possible. So yeah, he gave a little background on Canso. We've been around since 1997. As you see there on the first slide, our focus is on credit, which is basically lending in another word. And we have, as was said, roughly 38 billion in client assets that we're managing. A couple more facts about Canso. The people who created what we think is quite a good long-term track record are still with the firm now. So that's kind of unusual. And Another thing that's kind of unusual in money managers now is we're 100% internally owned. So we are focused on performance, and we also invest in the same strategies that you invest in. So our interests are very much aligned. The next slide is just a little bit of a breakdown of the $38 billion in assets. And just very quickly, it's basically just different flavors of credit there on slide 2. Where we have what is called investment grade strategies, where that's one of your funds that doesn't buy bonds that are rated below BBB. Those are so below BBB is what's called high yield, and investment grade is above that. Broad corporate allows a bit of high yield on a tactical basis, and then our kind of flagship strategy, your corporate fund, what we call corporate value, is not restricted by credit rating or duration or like interest rate sensitivity. So that's kind of our go anywhere credit strategy, and it has the best long-term track record. But we have a bunch of different strategies, basically, what is suitable for the individual client. So that's the background on Canso. I didn't want to spend too much time on that. Let's get to the next slide and kind of what's going on now. If you've been following this, you might have noticed that government bond yields, not sort of every day, but have been trending up for the last little while. And there's a kind of a primary reason for that. And it kind of relates to this inflation question that kind of keeps coming up. You may have seen the US CPI numbers this morning. Inflation numbers were quite high, 6.2% in the US year over year, 0.9% just in the month of October, which annualizes to quite a high number. And that's actually the highest year-over-year inflation in 31 years, as I read in the report. And what's causing that? Well, there's been unprecedented stimulus for quite a long time, both in terms of low interest rates and more recently with government spending. And now you have central banks kind of in response to this inflation creeping up, announcing that they're scaling back some of their stimulus programs in terms of, say, buying back bonds that was keeping interest rates lower. And in response to the pandemic, you have not totally in response to that, but partially rents going up, which is a big part of CPI. And especially in the US, to some degree here too, wages going up as people are less willing to do some of the jobs that I guess they were beforehand. So interest rates are rising. And it's really inflation that's kind of driving that. But just as important, or almost more important to a credit manager, are what we call credit spreads, or the additional yield you get on a corporate bond relative to a Government of Canada bond that the government bond has no real credit risk. So this chart here shows you the additional yield or spread that you get on an investment grade Canadian bond going back to 1998. So quite a long time. The average additional yield is a little over 1% or 100 basis points. That's the dashed line. And you see though how that spread can move around quite a bit depending on people's views of credit quality in the market. So 2008 spreads widened, as they say, quite a bit, so that the bonds actually got cheaper relative to Canada bonds. And then more recently, the spike up on the far right there is the pandemic, where corporate bonds sold off significantly in March of 2020. And then with various government supports and people realizing sort of later that the vaccines were working and all that kind of thing, spreads have kind of come back in again to actually more or less where they were before the pandemic started. And so that's important because if you were able to buy bonds when they were wider, as they say, and then have them outperform as spreads came back, you were able to do quite well. And we did do some of that in the funds. But the main message of this slide is corporate bonds right now in Canada are, and this is the overall market, are not really, really expensive and not really cheap. So from that perspective, they're not a great buy, I guess, or a great sell. But the main point is that within that, there are still pockets of opportunity, primarily in industries and companies that have been affected by the pandemic. And then the next slide is high yield, as I mentioned earlier. So these are credits that are much riskier from a credit perspective, a greater chance that you may not actually get paid back on the interest and principal that you've been promised. You see that the sort of shape of this is similar to the prior slide, but the scale is much wider. So in the spike in the far right there, high yield bonds, which are riskier credits, spreads got out to over 1,000 basis points in March of 2020. But since then, really, they've come back significantly to the roughly 335 that you see there at the far right of the slide, and are actually at levels now that are tighter or lower than they were even before the pandemic. There's been big demand for high yield. Companies have been very happy to issue high yield because of those conditions. And that's the kind of the thing with high yield is if there's a big demand and companies see they can refinance their debt at better terms, then they'll go ahead and do that. And so that's been a big feature of markets recently. But just kind of the final point on this slide is a big reason for the performance that we've achieved in the corporate fund for the last year or so is that tightening that we've seen, and big price increases on some of the things that we bought much earlier in the pandemic. Okay, so that's kind of what's been happening in the markets. The next slide is called historical allocation to high yield. So these bars just represent the percentage in the corporate fund that has been in high yield bonds. So remember, that strategy has no real limit in terms of either maximum or minimum in riskier credits. And so you see how that weighting has moved around quite a bit over time. And this kind of gets to the question of, people are asking us now, have we missed kind of the big rally? Is it kind of too late to be investing with Canso and questions like that? And our response is, hopefully addresses it a bit by this slide, where when things get expensive in high yield, as they are now, then our exposure to high yield actually goes down, because to us, we're quite happy to take credit risk, but only if we're being paid for the risk we're taking on. So what's happening now is the allocation to high yield in the corporate strategy is going down. Even now it's down closer to 50%. So this chart is a little bit out of date, and that's typically what you see. And so we give up maybe a little bit of yield, but not a lot, because spreads are so tight, and we're very well set up for for a buying opportunity that will come later. We don't ever know exactly when that will happen, but we've done that many times in the past. If you look at 2008, we had a very low weighting in high yield going into the credit crisis. And in more recently, it wasn't that we were anticipating a pandemic, obviously, but spreads were tight again back in 2018 and 19. And again, our high yield weighting was low, but that set us up very nicely to buy things when they sold off in 2020. So that's, something that we've always done. And I think it's a good argument for why, we don't think it's a great strategy to kind of jump in and out of our funds based on, whether you think we've sort of, there's not a lot of great things to come. It's just because we're at the same time adjusting the portfolios ourselves to kind of deal with changing conditions in the marketplace. Okay, and then the next slide is to give you an example of the sorts of things we can do as a kind of large institutional manager versus an individual. I mean, compared to equities, buying and selling corporate bonds is very difficult for an individual. The bonds go through more hands before they get to you. The dealers limit the bonds that are available. The prices are not as good and all of that. So this slide that's called reverse inquiries, again, goes back a few years. But these are examples of bonds where we have gone directly to the issuer that is listed there, whether it's Air Canada or Disney or Ford or Apple, all names that I'm sure you're familiar with. And we've said to them, it looks to us like you need to refinance, or you should probably think of issuing a bond. And if you were to issue it with more or less these terms, we would be a large buyer of it. So the most recent one, and we have a slide just on Air Canada, so I won't spend much time, but we were large buyers this past summer of a $2 billion 8-year issue that Air Canada did. And we bought $1.5 billion of the $2 billion. So, when we say we'll buy a certain amount, they can count on us to do that. And that's important when they're thinking of what they might do. And it's also, even though obviously we can't dictate terms necessarily, but it's much better to be at the table negotiating with the company than kind of waiting for dealers to come to you with what they think you might want. So that's been I wouldn't call it a primary feature of our strategy, but it has helped fairly significantly, at certain times. And, and I think Air Canada is a reasonable example, although some of you may have heard it before, but just the next slide, it just kind of quickly goes through that, where they had to raise money in the summer of 2020 after their business was hit, with the pandemic. We bought a much higher coupon bond then, which was also secured. And it's kind of a detail, but high yield bonds are often not secured, and we like to have them secured. It's better for us if things go wrong. So we had this 9% bond, but then this past summer, they saw, along with a lot of other companies, that they could renegotiate the debt that they had at much better terms. So the bond that ended up being issued was 4 5/8, 4.65, which is a lot lower than 9, but still is a pretty good spread. It's over 300 basis points when it was issued relative to government. So we think that's actually quite a good spread over Canada's, even though it's lower than 9, given that now their business is significantly improving as we come out of the pandemic. And the other thing that, and this was partially due to being, doing this reverse inquiry and kind of leading the negotiation, we've gone from being in a second lien position to a first lien. And the bond that we bought last summer at $98 was redeemed early at 108.50. So that all worked out very well. And so Air Canada was a good example of people knowing who we are, knowing they can trust our word, and laying out sort of good conditions for us, but reasonable ones for the borrower too. So that's Air Canada. To give you a sense of how the portfolios look now, there's the Canadian fund and the corporate fund. And you see the yield to maturity of the two funds there. The Canadian fund's yield is quite a bit lower than the corporate fund because it has a much higher credit quality. And that's the main reason for that. But it will also do better if there's any kind of spread widening in the marketplace, if people get very concerned about credit. And it also has a somewhat greater sensitivity to interest rate changes at 6 years versus 3. And it has, though, no exposure at all in below BBB bonds. And then versus the corporate fund, which is a 3.7% yield. And remember, these are not returns. These are just kind of the flip side of price, if you will. But the corporate strategy has a higher yield, so it does have a somewhat higher expected return going forward, lower sensitivity to interest rate changes, but half the fund, which is actually quite a bit lower than it was even a few months ago, 50%, and that the direction of that is lower. It does make use of foreign issuers to some degree, but it's not taking currency risk because it's either foreign issuers in Canadian dollars or US dollars that are hedged to Canada. And then finally at the bottom there, it's always called fixed income, but because the coupons are usually fixed, but there's this whole other category of debt called floating rate, where the coupons change depending on the level of interest rates. And so when you ask about, say, what's going to happen as rates rise to bond prices, that is a bit of a headwind for bond prices, but we're making increasing use of floating rate, where the coupons will actually rise when interest rates rise and the price of the bond will stay more or less the same. And so you see that's 17% in the Canadian fund and close to 30% in the corporate fund. Okay, so that's kind of what we've been doing in a nutshell. The last slide is just outlook, but I've kind of touched on a lot of this. Things are getting better in the economies. But as I said, inflation expectations are significantly higher, and now we're actually seeing actual inflation also quite a bit higher. And interest rates are adjusting to that, because if you're being paid back in fixed dollar amounts, you want to have the dollar amounts you're getting back, not being wiped out by inflation, which they're kind of doing right now in many cases. But yields are actually slowly adjusting to allow for that. So that's in our opinion anyway, a fairly big change in bond markets. For 30, 40 years, we've had declining yields, and we've been kind of riding the tailwind that provided to bond prices. We really do believe that we're in a different kind of environment now, and we're positioning the portfolios accordingly. So I guess with that, maybe we'll take any questions.
You stole my first question with that final point. I was going to ask if in the last quarter there's anything in particular that has really sort of raised your eyebrows or reinforced your current thesis at Canso in terms of what you guys are doing. But I guess, is there anything really that stands out? I mean, obviously inflation, interest rates, tapering of purchasing through the Fed and the Bank of Canada. Is there anything that has really sort of raised your eyebrow in particular, or reinforced the thesis that you guys are working on?
Yeah, I'd say more reinforcing. I mean, we have been calling for higher inflation and interest rates for some time, and frankly, we have been, until recently anyway, kind of wrong on that. But it does seem now that when you have the ultra low interest rates that we've had for so long, and now combined with the heavy government spending that we've had during the pandemic, and now the economic rebound that we're seeing as we kind of hopefully come out of that, inflation is significantly higher. And the one thing with inflation that, you have to be as old as me, I guess, to remember the 1970s and wage and price controls and all of that, where there was actually a government body that was supposedly trying to set prices. Inflation is very reinforcing. When prices of things go up, then people want wage increases, and when wages go up, then companies raise prices, and it becomes a bit of a self-reinforcing thing. So in our opinion anyway, it's hard to stamp out once it kind of gets going, and in our view, we may be in the early stages of that.
So I'm going to ask just a couple of questions here. Just the first one is just noticing the mustaches on both you and Faisal, and just wondering if Movember is something that you do at Canso, or is that everybody just seems to have a mustache?
Faisal, every year now, I'll let him answer this because he's been a great leader of that whole project.
Yeah, we participate. We have a pretty good campaign at our firm, and this year we're really trying to come out on top and be one of the top fundraisers for Movember. So yeah, pushing hard, and this isn't normal for me, but and Tim, I don't know, it suits Tim, doesn't it?
No, it does. It does, but over the last sort of week when we've been talking, I've been noticing that the mustache has been getting bigger and bigger. So that's why I just noticed it was much bigger today. So yeah. Just a couple of observations is that when we hired or asked Canso to manage our bond funds is that one of the reasons why we picked you is because of that independence and the fact that that you're more focused, that everybody internally is an owner. You don't have some outside shareholder dictating what you should do. And I think that that's a good foundation and philosophy, for an investment manager. You have it, Pembroke has it, and William Blair have it. And so our three main managers, actually, and Guardian Capital, I guess, maybe has it as well. And so it's a good foundation for just concentrating on what you're doing, and delivering positive, absolute returns and beating the index. Just on to just one of the knocks on bond funds has always been the fact that when interest rates rise, is that you can't get out or if you do, you take a loss, and then the market, interest rates fall, and you're mistiming the market. But in yours, you have to mitigate against that. You have the floating rate notes, but you also would have an amount that would be maturing each year, and that you could roll over at higher rates if interest rates went up, which is sort of the concept of a bond ladder as well. So what would be sort of an amount that might mature over the course of a year in your portfolio?
That's a good question. I don't know, Faisal, do you have a sense of that? It would depend on the percentage, I guess, in short-term bonds. It's reasonably significant. But the other thing we're also doing is not waiting always for the bonds to mature, but we're always happy to hold something to maturity when we buy it, because you can't assume you can sell it. But we're always looking at what we have versus what we might buy, and if we find something that we think is more attractive than something we already have, then we'll try to make that trade. So that's going on also.
Drew?
Sorry, I was just reading an audience, a question from the audience that we'll get to eventually. Another thing that you touched on briefly was sort of your rollover into higher quality, going back to 50%. And I know you guys were very well positioned in 2020. Now, do you see that sort of speeding up, I guess, going back to higher quality? Are you expecting something to happen in the market, or is it sort of a continuous, just sort of look for opportunity where opportunity presents itself and be well positioned to capitalize on opportunity? Sort of.
I don't know if we're allowed to pick both answers, but I mean, that's kind of basically what it is. We don't have a crystal ball for exactly how things will play out. But one of the beauties, if you will, of our strategy is we don't have to necessarily correctly forecast the future direction of interest rates in order to outperform. We look at what's available today, and we think we have a pretty good sense of what's good value and what's not so good value, and that's where we'll position. And right now, we're not seeing great value in a lot of the high yield names that are out there, and that's why we're selling those down. And so, it's reasonably likely that our 50% weight could go even lower than it is now, because there seems to be still a pretty good demand for riskier credit, because everybody wants yield. But I kind of touched on, remember, yield is not return. So, it's a very dangerous strategy, in our opinion, to buy the highest yielding bonds that you can find, because, you may not get your money back. And that's kind of what we focus on all the time.
I'll ask a question about risk, and risk is, in some people, it's the volatility, the price action of the underlying of the bond portfolio. If it goes down 2 or 3%, they think that's risky, when that may not be. If you were to take a look at the Canadian bond portfolio, which has mainly investment grade bonds and governments, versus the corporate value, which one would you say is riskier? And and I guess defining risk as a negative return.
No, it's a great question. The thing is, I guess they both have risks, but in quite different ways. The Canadian bond fund is more tied to the direction of interest rates, so it will be more negatively affected if rates rise significantly. Whereas the corporate fund is much more tied to the ability of the companies we've essentially loaned to pay their money back. So, any kind of credit problems will be, they'll show up more in the corporate fund. So, which risk is higher? Well, they're kind of both there. In historical, if you look at the history, the corporate bond fund would have more volatility in its returns. At times, at least over short periods, more downside because spreads can be volatile. But over the longer term, the corporate bond fund has done better. So it kind of depends on where it fits in your portfolio. I guess that's where Pembroke comes in. If you're looking for your bonds to be really the anchor and the extremely safe money, then probably the corporate bond fund should be de-emphasized in terms of the safer fund.
So just as just a quick follow up is I know that since you've been with us, let's say for 11 years, is that there's never been a negative year on the corporate bond fund. I don't know that that's the case, for the investment grade bond fund. If your mother said, Tim, I have a couple $100,000 that I want to put into one of your two bond funds, which one would you be telling her to put it in if she had a 2-year time horizon?
If she had a 2-year time horizon, truly, and again, this is where I think you guys at Pembroke are much better suited to give the answer than us. But my answer would be you're probably the corporate bond fund is probably, you wouldn't want to have all of the money in that. I guess is my answer, because it is designed for a longer term kind of return, someone with a longer term expectation.
Okay, but you don't have that choice of a little bit in one, a little bit in the other. Anyway, so you're just in the corporate bond fund. I like that. That's fine. That was the answer I was looking for. Go ahead.
I was going to ask it. It's interesting with the corporate bond fund because you guys have obviously you excelled in 2020 and you took some opportunities with some interesting names, and I was just wondering if you could highlight one of the names like a Hertz or something like that a little bit of the methodology about how you went through that and analyzed and said this credit looks good to us, even though, the equity paper was, garbage.
Yeah. Well, no, Hertz is a great example. I'll try to really summarize, but it's actually quite a long story. But it's a good example of how something can really pay off for us over a longer period and a kind of with different security. So, we were not really looking at Hertz at all prior to the pandemic, not in any kind of detailed way. But then the pandemic hit. Hertz was more negatively affected than the other car rental companies because of they had more airport locations, and they had to rapidly sell off cars because the demand collapsed. And the feeling when they were doing that was that the price of used cars would collapse because they would be dumping all these cars along with other car rental companies onto the market. But really our key insight, and it actually worked out way better than we even initially thought, was that, yes, they would be dumping cars or selling them anyway. Dumping is maybe the wrong word, but at the same time, there would be a lot of people who would want a car because they didn't want to ride on transit, or they needed a second car to kind of get around or whatever. And we thought the prices of used cars would not be as negatively affected as the market seemed to believe. And that was kind of our key insight. And so we were buying Hertz bonds back in the spring of 2020. And they also had more complicated securities, these asset-backed ones where the cars were actually held. So there's collateral with the cars, and those didn't sell off as much. But the actual Hertz bonds back in 2020 sold off significantly because the market thought they were actually not going to be able to pay them back. And it ended up being Hertz declared bankruptcy, went into, in the United States, Chapter 11, and went through a long, complicated restructuring, which only got resolved in July of this year. So it took quite a long time for that to work itself out, and there were competing players trying to bring them out of bankruptcy, and Canso was significantly involved with one of the groups that was trying to do that. And it's very time consuming. We have been involved in those in the past, and it's quite interesting, but it's also very time consuming. So but because we were large holders of their bonds, we were able to have a seat at the table, if you will, and that was very helpful. Anyway, it ended up where the other kind of group of people that wanted to take them out of bankruptcy ended up being the winners, if you will. But it wasn't like we lost in that situation. All the bonds we held that we bought at big discounts were paid off at par. And so we made a lot of money on those bonds. And in some accounts, actually, where we were allowed to hold equity, not in your funds, but we had a bit of that as a result of the restructuring, and that's done well. And now, if you follow it, Hertz is, they have some equity that's trading. They have more equity that's actually privately traded that's come out of the restructuring, but it will ultimately be a public company again in a better financial situation. And it's just been a good story. And I've kind of really glossed over a lot of the details because it's been quite a thing over the last year plus, but it's worked out very well for Canso. And it's kind of been the result of kind of a key insight that worked well, and then really diving into the details of what you might buy and what we should really do, and trying to do our best to influence the outcome. So Hertz has been a good story.
I mean, you basically the Hertz bonds appeared sort of really at the end of March, maybe just the beginning of April, within the first week of April. I mean, what would have been the time period between your first contact with Hertz and the time that you made your, and I don't know what was the dollar amount that you invested, because you have it in all of your mandates, all of your corporate value mandates, but would that have been a 2 or 3 week process that you did?
I don't know. Maybe I'll let Faisal comment on the timing, but it was very quick, and that's a key example.
We started buying, I think, end of March, probably March 30th, and we continued to purchase their bonds, so unsecured and second liens, probably until close to the end of April. And the average cost on the unsecured is probably around $25. Some low buys of 17, and then Tim had just mentioned, once everything was said and done, they were called this past year in end of July, July around at about 103. So, profitable insight looking at the bonds and seeing what we loaded up as much as we could, and we chipped away though over time and just found what we could find.
Just to clarify for investors in the fund, like how big a stake could you possibly take, and still be within your mandate?
In the corporate value mandate, probably 5%, based on the credit rating. So yeah, to 5% the bonds.
Then the key thing there is, as the price goes up, the weighting can go up, and that's still a good discipline where we can start to trim bonds off as the weighting goes up and take profits. But right now we really don't have that much exposure to the debt anymore, because as we said, they paid the bonds off, but it was all a very good story. There's some kind of ongoing disputes about exactly what interest is owing when they were bankrupt, but that's a small part of the portfolio.
Can you explain just two things? One is that when we hear about the Federal Reserve buying bonds, and I guess the Canadian Central Bank buying bonds, are they buying bonds that we own? Not our bonds, but are they buying the same bonds that are in either the corporate value or the Canadian bond fund?
They might. I mean, the Fed, and that's what really turned the market around back in March of 2020, was when the Fed announced they would sort of step into the markets, and the Bank of Canada announced a somewhat similar program, because they don't normally buy corporate bonds. I mean, the central banks don't usually do that. So I guess the answer is they probably wouldn't buy the bonds that we have. But remember, a big determinant of a bond's price is interest rates. So if they're out there buying almost any bond, and that, and if that pushes interest rates down, then that will affect most of the bonds that we have too. So that was one of the reasons why interest rates have stayed lower than we think they really should have. But now I think they're largely out of that. They're scaling back their purchases.
Can you just on from that, is that these tips, these inflation bonds that are out? I mean, you would think that they would be a great buy, for people that would have bought them, let's say 6 months ago, because inflation's gone up and they're in practice. I can't say that I understand them. I mean, can you give a 101 layman's explanation of what these bonds do?
Well, I guess the first comment is it's kind of one of these don't try this at home kind of securities. I don't think they're really suited for individuals, but I mean, at first glance, they sound great. If inflation is going up, these are tied to inflation, so that sounds really good. And they are to a degree because the coupons will actually rise as inflation goes up, and the final principal amount also. But the thing that is kind of forgotten about a lot of these bonds is they're very long term. Like they're typically, at least when they're issued, 30-year bonds. So the payments come over a very long time period. And just because they're real return doesn't mean they're unaffected by changes in interest rates. And because of that high duration, that high sensitivity, which in this case is to real interest rates, they can be really negatively affected by real interest rates going up, which is simply, the interest rates you see minus inflation. So real rates can go up too, which is kind of what's happening now. And so, again, the short answer is, yeah, they sound good, but they're not quite as straightforward as you might think. And rising rates will also negatively affect them. That's why we prefer actually floating rate securities where the coupons will rise with rising interest rates, but they typically are also a much shorter maturity.
When we were preparing for this call, Tim, you had a really interesting perspective on, I referenced a Globe and Mail article that came out recently regarding, bond ETFs. And, 2021 was a poor year for bond ETFs, and it was one of the first negative year for bond ETFs. And I was just wondering if you could comment on that, as to why that's the case, and sort of, lean on why managed portfolios in the fixed income space are going to, capitalize on this.
Yeah, I'll try. I mean, all these questions, you could spend a lot of time. But anyway, ETFs, as you know, probably are normally based on broad market indexes. And so equity, it could be the TSE or the S&P 500, very broad markets. And so, we can kind of get our heads around why you might want to buy an equity ETF like the TSX or the S&P, because if you don't really think you can pick managers and they typically are fairly cheap in terms of fees, then fine, go ahead and do that. But the thing is, debt is very different, right? Again, these indexes are weighted by the market value of the securities, which in the case of debt is simply those companies that have the most debt. And so when you buy a bond ETF, you're basically buying a portfolio of companies that is skewed towards ones that have the most debt. And our question would be, why would you want to do that? You're far better off, in our opinion, to be much more selective in what you buy and really focus on those companies that are, in our view, able to generate the cash flows to pay you back. And we really think that taking a sort of broad market approach to buying corporate bonds is not a great strategy. And I think that's been kind of borne out so far this year when, the overall market has a fairly high duration. And so because of that, rising interest rates have been very negative for those kinds of things. So obviously we're biased because this is what we do. We're active managers in credit, but I think the numbers have shown that it's a better approach.
We have a question from a listener on the call, Irv, who's asking, you alluded to a maximum exposure to Hertz of, let's say, 5%. He's asking, is that 5% of the assets that you have under management in that space, or is that 5% of the Hertz outstanding bonds? And let me just also add, is that the book cost or the market value? Because if you're buying Hertz at $20 and it goes to 40, your book cost may be 5%, but your market value will be 10% of the portfolio. So,
Faisal, you want to take that?
Sure. Yeah. So the 5% is of the portfolio, not of the overall structure. So we can buy up to 5% in the Pembroke corporate bond portfolio in Hertz. It has to do with credit rating. So we have a cap of 5%, anything below single B.
And
That
then
answer, yeah, it's not based on the total debt of Hertz. It's the portfolio
based
we're
on that.
managing.
Yeah.
And then you would, and again, Pembroke would have its own specific restrictions within that. I mean, your composite portfolio may be more than 5%, and it may be 5% just of book cost. So if you never sell it, you can write it up. Whereas for Pembroke, we might say 5% of book and then only 7% of market value.
Typically, it's there are different, a book, and then you can go to 1.5 times over that. So we would potentially be we'd be forced selling it if it kept on rising. But that's how we mitigate the risk though in that portfolio.
It does depend, though. I mean, because even if Hertz bonds are rising, if other bonds are rising also, then the percentage may not be going up as quickly as you might think.
And well, that's true. You have energy bonds, which have had a bad. If you were an investor in 2016, that would have been a bad investment as oil went to $26. But you've ridden sort of again a good timing on that. Is that energy companies, are they still being put in the penalty box in terms of the interest rate premium that they have to put on, or are they now sort of the golden boys because of what's been happening with the price of oil?
I mean, they obviously improved substantially, and that's why. I mean, we don't normally buy energy because as lenders, we're not that happy about, the revenues are driven by the price of oil, which is not as predictable, obviously, as another more stable industry. But in 2020, when oil sold off and the bonds sold off incredibly, the opportunity to us was just so compelling that we bought into that. And now with oil prices rising and credit markets in general, much more tight and expensive, we are selling those. I mean, so when we're selling energy, it's not because we have really concerns about the energy companies. It's kind of the opposite. It's just that they've done so well that the bonds are really not that attractive anymore from a future return perspective.
Drew, do you have? I have.
No, I was just going to ask you. The last question I have is, what's the average turnover of the portfolio?
Yeah, good question. We get that a lot. The reason I hesitate is because it's not constant. We can go for
understandably.
We can go for long periods without really doing much of anything, if you will. Our activity is lower right now than it was a year or so ago. But back, say, in March of 2020, it was essentially all hands on deck at Canso, and we were extremely active because there were just great opportunities to be had in the marketplace, but you had to act quickly to get them. So our turnover in that period was very high, but right now it's lower. So I don't know if we have an overall number, but it's not really that helpful.
Okay, we're getting another. Ask the question that just came in there, Drew.
Yeah, just pulling it up here. Sorry, guys. Oh, they're saying so the question came in, where are you guys seeing, are there any pockets in particular that have really drawn your eye in terms of opportunity space?
Yeah, a little bit, but just not the great opportunities we saw a year or so ago. So there's some companies that have been high quality companies that have been issuing in Canada more recently, foreign companies. And so we've been a buyer of those. And the other thing I would mention is the banks and insurance companies have been issuing these things that have this clumsy name of limited recourse capital notes, or LRCNs. They're essentially subordinated debt. You don't get paid off, and if there's a bankruptcy, nearly as well as senior lenders, but because of that, they come at a higher interest rate, a higher spread than their senior debt. But in our opinion, the spreads you're getting on those are still pretty attractive. So we've been buyers of those too. It's kind of another big thing that's going on in the marketplace, where preferred shares that have been largely a retail thing for many years, the regulator is trying to get people out of preferred shares because they think they don't totally understand maybe what they're buying sometimes, and shifting all of that sort of security into the institutional market. And so these LRCNs are almost kind of a form of preferred share, and those are, pretty attractive right now too.
I guess just a quick, sorry,
Go ahead.
just a quick
Go ahead.
follow-up to that. Are there any places in the market that you feel that spreads are unjustified? Like you sort of get a little wide-eyed when you see that they're.
Well, yeah, and actually in more things than not. As we said earlier, spreads on high yield are extremely tight. People are buying so-called high yield bonds. I mean, they're called high yield for a reason, but right now, in many cases, they're not that high. The coupons are less than 5% in many cases for companies that are fairly risky, that there's a decent chance that they'll run into problems. And often with high yield bonds too, if you're not secured, you're behind other lenders in a bankruptcy, and your recovery might be very low. So in general, we would say a lot of the opportunities out there are not very good.
Okay, just one other question for Merv is, what's the average life of the bonds in the fund? Is it 4.7 years or 6 years or 3 years? How does it compare to historic averages for Canso? I guess that's in the corporate bond fund. And when you say the life of the bond, I guess that would be the maturity of the bond.
The average term of the portfolio is currently, the term is about 6.8 years, but you have to remember that just because there's a term of, say you buy a 5-year floating rate note, the term is going to be 5 years, but your duration is effectively going to be, if it's quarterly, pays quarterly interest, it resets their duration every quarter, so it'll be about 0.25 years. So your duration, that's why you have a shorter duration, about 3 years, and your average term for the portfolio is a little bit longer though.
So just on a performance, and maybe we should have started with this, but for year to date to October, the nice thing is that I guess what we want you to do is two things. One is to generate positive absolute returns, and number two, to be able to beat the ETF, which is sort of a do-it-yourself mechanism out there, or even a ladder, which you would have at most brokerage accounts. But for year to date on the investment grade, it is down 3.56, but the index is down 4.96, and so you've added value there. And then on the corporate bond fund, you're up 8.5, and the index is down 3.26. So there's an 11% delta on that, and so I think that our clients, speaking on behalf of all of them, is that very, very, very happy with the results. I mean, certainly as you get older, bonds become a bigger part of your portfolio. You want to keep ahead of, you want positive returns and be ahead of inflation. And when things get volatile, it's not as volatile when you have bonds in your portfolio compared to equities. And so for people that have lower risk tolerances, I think that they've been very happy with that. This call is taped and will be replayed. And I'll let Drew have the last word.
Thanks, Peter. I want to thank both Tim and Faisal for spending the time with us. I think the listeners on the call will notice that there is a distinct parallel between Canso and Pembroke, and there's a reason why we partnered. You both, we see a lot of similarities in the equity market in terms of selecting securities, excuse me, as you do in the bond market. Taking your opportunities where you can and finding appropriate risk to allocate clients' capital. So I want to thank Peter for co-hosting, and Tim and Faisal for representing Canso. Once again, it's always a pleasure to talk to both of you and hear your views on the market and what you guys are doing within the portfolios. So we will we'll look forward to 2022.
Thanks very much. And as I said, we're very proud of our association with Pembroke and look forward to more returns going forward.
Yeah, more happy.
Yeah.
Thank you.
Okay, thanks, guys.